Hey everybody. In the last video, I covered off, my approach to investing using the dollar cost averaging methodology, if you like to call it that, and how I'm using a sort of modified version, whereby if a stock has performed the least, then I apportion more of my funds towards it, and if a stock has performed the most, then I apportion less of my funds towards it. So it's now time to sort of reinvest. So I've added another 1,000, and I've still got my 10 stocks that we went through in the last video. So Taylor Wimpey, Barrett, CYBG, Lloyds, Aviva, Legal & General, Barclays, Man Group, Centamin, and Imperial Brands. So I'm looking to start investing now. As you can see, Centamin and Man Group have had the biggest or the least performance, the biggest declines in the last month since I last invested. So I normally do about £100 for each stock on average. My contribution to those two will be slightly higher. So and the reason for that is that the way I look at it is that with Centamin, because I believe in it long term, I believe that if I put more funds towards it now, I'm effectively buying the same product at a 17.52% discount. So effectively, I'm getting 20% off. So that's the way my mind sort of rationalizes why I'm making this approach. Whereas if I apportion more funds to say something like Legal & General, I'm paying 16% more than I should be paying for it, if that kind of makes any sense. So go ahead. I go to Centamin, obviously hit buy. My average is 100, so I'm going to do 120 because I still want to invest in absolutely every single product. Hit basic order. So that's going to give it to me at market price. Confirm buy. Put in my PIN. And that is going to be that. That's perfect. That's queued for 4 p.m. UK time when that will get effectively purchased. So the next one that fell was Man Group. So I've decided to invest 115 into Man Group, and I'm just going to go do that there. Basic order. I do basic orders rather than instant orders because I'm dollar cost averaging and I'm not effectively trading. Getting in at the exact timing and exact price that I would try to do if I was, for example, trading is less important to me at this stage. So the price will probably fluctuate, obviously, by the time it actually accepts the order at market price. But the sentiment will probably still be the same. So it allows me to obviously save that money, save that pound. And it doesn't have that much of an impact in terms of the price that I'm buying at. Now, Barclays is the next one I'm going to invest in. Now, this is the only one that I'm going to break my rules slightly. And there is a good reason why I'm actually going to invest more funds into Barclays. And so what I also look at is not just the performers that have, the stocks that have performed the least. I also look at who's looking to pay the dividend closely. So it's looking like Barclays' ex-dividend date will be in March. So because of that, it's better for me to get a bit more shares in Barclays so that I can hopefully get a bigger dividend very soon. So that's where Barclays, although it has been performing, I'm going to break my rule slightly for Barclays specifically. So the next one is Aviva. Where are you? So I'm really excited about the insurance industry in the long term. I covered off in the last video how I think that the insurance industry has got it's had a lot of growth year on year, and last year has been very considerable considering its size. But actually, it's got a long way to go in terms of technology, in terms of products, in terms of diversifying the types of products that it actually serves. So I think Aviva is going to be a good brand in the long term. The next two that sort of performed okay is Imperial Brands and CYBG. So I'm going to put 105 into Imperial Brands, which gives me 4 shares. They're quite expensive at £25 per share, roughly. So that's Imperial Brands done, and then I'm going to put 100 into CYBG. So if I invest 100, that effectively just maintains my normal approach. It effectively is saying that you haven't performed, above market considerably, that I'm going to drop the amount that I'll invest, but also you haven't performed considerably bad, that I'll give you effectively more. So it's an investment that I sort of consider is doing what it should be doing effectively. So that's CYBG. The next two that sort of follow that suit is Lloyds and Legal and General. So where's Lloyds? There you are. Buy Lloyds, and I'm going to buy them at 100. A basic order for 4 p.m. Confirm buy. I do really like the free trade app. I think it's very smooth, very quick when you're making your purchases. And then we've got Legal and General, so which is another 100. Basic order. Sorry, I know this isn't probably the most exciting thing to watch, but I thought it would be nice to be clear early on, and then hopefully in later videos we can talk about stuff a bit more exciting. And so my last two, which I'm actually going to invest less in, and that's because they performed the best, is Taylor Wimpey and Barrett. So Taylor Wimpey, I'm going to invest 80. So if I go buy and I go 80 and basic order, review, confirm. And again, the reason why I'm doing this is just simply because I believe that I'm buying them at a higher price because they put me in performing well. So what I would like to do is try and get some of the discounts from other stocks that I believe will perform just as well in the long term, effectively. I know it might seem a little bit counterintuitive, but there is a method to the madness, I do promise. And I'm buying 50 in terms of Barrett. So that effectively is all done. So as you can see, everything is now being invested. When those orders are actually fulfilled, then there will be some change. And what I will do is sort of reinvest that change. I think for me, one thing I'd like to say is that when it comes to investing, one thing that I've learned over the last sort of year and a half, encroaching on 2 years, is it's really, really important to have a strategy. There's nothing worse, this is just my opinion, but there's nothing worse than, what I call aimless investing, just investing over a hunch or investing over something that's not sort of concrete that you can learn and adapt from. If you have a strategy, however correct or however incorrect it may turn out to be, it's better to say, this is the reason why I'm going to take this approach, and I'm going to do it over this period, and this is the amount I'm willing to risk. And therefore, you're in control. You're setting the amount of money you would like to invest, you're setting the amount of risk you're wishing to take, and you've got a reason for your strategy. And if it works, great, then continue it and hopefully try and increase and expand. And if it doesn't, then hopefully you know why you failed, and you can kind of adapt from that strategy, and you can continuously learn. I often think if say Ray Dalio and Warren Buffett represent 100% of knowledge of the stock market, which they don't even, because there's so many different types of securities and asset classes and so forth that they don't even get involved in. But let's say they did represent 100. I, in my opinion, probably am around the 2% mark, 2.5% mark, which I find is really exciting. So if I'm getting a little bit of profit with 2% of knowledge in the stock market, then as I increase my knowledge, then hopefully the profit should effectively increase. And so what I wouldn't want to do is sort of fail at investing, but not know why I failed or not know what approach I've taken. So I'm really sort of determined to stick with sort of this approach for at least 6 months to a year and see where it goes, and sort of take it from there. I think to be a good investor, and again, this is sort of my personal opinion and not necessarily any sort of fact, but to be a good investor is to sort of be a bit emotionless. The way I sort of treat, investing, or the way I react to sort of profits and losses is, if I get a bit of profit, okay, cool, great. If I lose some money, okay, cool, great. I don't really react to it just because you can be up one day and down the next day. And if you react based off, intraday movements or weekly swings, then I think you effectively lose control. And, the stock market is almost guiding you and telling you how to behave, whereas it should kind of be the other way. Obviously, you can't tell the stock market how to behave, but what you can do is control the way you decide to behave and respond. And how you choose and select stocks to sort of invest in. There's a lot more I want to sort of talk about the psychology of investment, but I know this video is probably dragged out a little bit. But this video, the purpose was to really just show you, obviously with my normal dollar cost averaging approach, how I've kind of given more to the ones that perform least, as I mentioned, and given less to the ones that have performed better, and the ones that have performed okay, I've sort of maintained the same level. When they're all fulfilled and it gives me, say, maybe £6 or £7 in the kitty, I will just reinvest those £6 and £7 in usually the least performing, or in this instance, I might reinvest them into Barclays just because it gives me more shares, which I can earn some dividends for, because I believe they'll be paying a dividend in March if my sources are correct. I'll do a follow-up video soon just to see how this is performing, maybe in a few days or so. Please like, please comment, please subscribe. If you've got any tips, any advice, anything you want to know more of, anything you want less of, more than happy to hear. I try to respond to absolutely everything. Actually, I will respond to absolutely everything because I don't get that much comments just at this stage. So I will respond to everything, and all messages as well. But good luck with everything. Hopefully your portfolio yields the success that you want. Wish you all the best. Take care. And I will catch you next time. Take care, everybody.